Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include storylines from around the industry as we enter December, my interview with United Home Loans President Mike Dulla on borrower sentiment and winning business in the current rate environment, automations with humans in the loop, and where lender executives are focused. And in the capital markets, steady as she goes given no news. Whether it's applying to rent an apartment or take out a loan, today's approval process is full of blind spots and inefficiencies. Critical data sits locked inside documents, leaving companies with an incomplete picture that causes delays, increased risk, and inconsistent decisions. 2Dot's ambition is to build a better system, one where underwriting and screening is automated, not manual, where applications happen in real time within a dynamic and contextual conversation, and where better decisions are made faster for everyone. Unlock unstructured financial documents, which unlock smarter financial decisions today by visiting 2dots.net. A buddy of mine from Kentucky wrote to me saying, statistics show that the average person has sex 89 times per year. Looks like I'm in for a pretty wild December. November is behind us, and with it all the noise about President Trump and Director Pulte's 50-year mortgage proposal. Capital markets in the mortgage business don't like thinking about how long it would take to create a market for 50-year mortgages, nor do they like volatility, but some traders do. The mood among traders has swiftly improved, chiefly due to the economic data that has supported an interest rate cut in December. The Federal Reserve's Open Market Committee doesn't set mortgage rates, but the same factors that influence its decisions impact the bond market. A slow jobs market reduces the number of qualified borrowers, but tends to lower rates. Pick your poison. Yes, it appears that bond yields are ending 2025 in familiar ranges as markets now fully price a December Fed rate cut and can look ahead to early 2026 data, Fed leadership uncertainty, and the resumption of BLS reports to guide January expectations. Despite a modestly steepening yield curve, near-term bias favors lower yields with technical levels in 10 years and 30 years in focus and supply-driven term premium likely to temper the pace of any duration rally. With the curve still underperforming steepening expectations and the Fed potentially moving toward a sub 3% terminal rate, the outlook hinges on whether front-end outperformance continues, how the new Fed chair selection unfolds, and whether demand for duration can offset ongoing concerns around Treasury supply. For today's interview, I want to welcome to the show United Home Loans President Mike Dulla to talk about borrower sentiment, winning business in the current rate environment, automation with humans in the loop, and where lender executives are focused. He founded United Home Loans in 2002 with a simple philosophy: to provide mortgage consultation that creates responsible homeowners for life. Since that time, UHL has grown from a small brokerage to a full-service mortgage banking operation and has closed more than $3 billion in loans.
I wanted to start a little differently than how I normally do. You're the president of United Home Loans. I read a lot of bios on here. How would you introduce yourself?
Wow. Okay. That's just a tough one right out of the gates. But I would say Mike Dulla, President, United Home Loans. I like to tell people that I'm probably the only lender in the mortgage industry that actually has a degree in real estate finance from University of Illinois. Don't remember anything that I learned there. Don't remember any of the classes. I know I had to drop appraisals once. So damn confusing back then. But we opened this company, or I opened this company 23 years ago, 2002. Love the mortgage industry, kind of love running a company and love the people that work with us. And I guess I'm a mortgage lifer. How about that?
There you go. Well, then you'll be very apt to answer my questions about kind of the overall trends that we're seeing in the market and that sort of thing. But I should say I played golf this summer at a place called Erin Hills in Wisconsin. They've hosted a major championship or two out there. And there was a young man caddying for me who also majored in real estate finance. He just graduated from the University of Colorado at Boulder. Should I hire him? He's been asking me about a job. He's been hitting me up.
Well, obviously the two career paths when you get a real estate finance degree are, mortgage banker or caddy. So honestly, one of our best hires ever was out of a Starbucks. She was a manager there. I saw the way she interacted with people. And I think that's just so much more of an important litmus test for people to see the way they interact and communicate with, with other human beings, as opposed to the degree or what they can fill out on the website or on Indeed or whatever the case may be. So yes, Robbie, I would say hire them in a heartbeat.
There you go. I like that. Well, speaking of interacting with humans, we'll get to kind of humans in the loop and tech here in a second, but I want to talk how people are interacting with their mortgage companies right now. And so the first part of that will be kind of the general sentiment amongst borrowers out there. The second part of that will be what borrowers are demanding from a process experience point of view, or what they're looking for from a mortgage professional when it comes to holding their hand a little bit. Let's start with the current rate environment. There's all this chatter out there of the Fed's cutting rates. I think it's less than a 50% chance now they'll cut at their December meeting. But the general public says, oh, well, if the Fed's cutting rates, mortgage rates must be coming down, which isn't necessarily true, but it could spur some people to get off the sidelines. What's the sense you're getting about potential homeowners out there, either those looking to buy or those that have already bought and are thinking about refinancing?
Well, I'll answer the first part first. I would say home buyer sentiment was extremely strong, I'd say, for several months as we saw rates drift down. I don't know what it was, a year and a half ago or so, we saw rates in the 7.5 range or higher. Earlier this year, they were probably clipping 7%. Right now, Freddie Mac average interest rates probably 6.25. So I think that brought some life back to the home buyer market, especially in the Chicago market. We have an office in Nashville. That market's a little bit softer right now. So I would say all in all, it was extremely strong. Of course, they get a little bit down when they see limited inventory. And that is, of course, still the biggest problem that we're facing. Rates, of course, are a big one. Limited inventory is a huge one. And then, of course, the price of homes is the third whopper right there. And I would say just recently, maybe over the last couple of weeks, perhaps coincidentally with Jerome's famous words like, what do you say? A December rate cut is not a guarantee, far from it, or something very close to that. Ever since he said that, it seems like calls have slowed down a little bit, but it's also the holidays. So I think we've seen that slow down a bit in the Chicago market. From a refinance perspective, they were so thin to begin with, where borrowers were saving 0.5% or 0.75%, that any slight bump in rate, which of course we have seen since he uttered those famous words, might take a few of those off the table. And I think we've seen that happen right now. We're also, and this is where, boy, getting your help on something like this, we need people to understand the importance of how to manage their mortgage correctly and just their finances in general. We have clients that were saving $250, $300, $350 per month. We're just like, we're going to wait for rates to drop a little bit. Well, now they're only saving 150, 175, and they're not doing it. You add that up over the life of the loan, or you apply it towards their principal balance each and every month, you're picking up 150, 175, $200,000 over the life of the loan with the house's money, with these newfound savings from a refinance. So part of it is, of course, rates ticking up a bit. Part of it was borrower apathy. And I think part of it was overconfidence with people waiting for rates to come down.
There's a couple of things that I wish I knew before I bought my home in terms of, well, your servicing asset is likely going to get sold. So be prepared to watch letterhead change. But more importantly, a fixed rate does not mean a fixed payment, especially when insurance premiums have had a recent propensity for skyrocketing. You might get a reassessment on the home's value and your property taxes will change. A fixed rate is not a fixed payment. I wish I knew that before I bought a house. But what you had championed to help out on the affordability front was a 529 type of savings plan for the down payment of people's first home. The parents, grandparents, buyers themselves could contribute to, and the earnings would grow and be withdrawn tax free. Hopefully, I didn't steal your thunder there, but can you add some color to this and talk about why you think it's a really good idea?
Yeah, it's just an idea I've had lately, and I'm sure it's been floated before, right? Like there's no way this has not come up and been presented in Congress one way or another. If it hasn't, that's kind of mind-boggling. I mean, we have this 529 plan in place for families to save for college education. I think you can use it for higher education, but 99% of the time it's used for college. For kids they don't even have yet. I mean, you can start a 529 for a child that's not even born yet. So we allow families to save all of this money tax-free to pay for college. yet we don't have a tax-free investment vehicle to help them purchase their first home. I mean, it just seems counterintuitive to me. It's counterintuitive to me. It's like putting the cart before the horse, right? Like we are willing to let them save for their college education, but we're not giving them the foundation of their first home where they're going to have these kids, raise these kids, teach these kids, and have these kids acquire the skills necessary to succeed in college and just succeed in life in general. And obviously, home ownership is the bedrock of our economy. It's the bedrock of the American dream. In my opinion, it still 100% is. And we should give them that opportunity, that tax-free savings opportunity, to allow them to save a little bit of money from a tax perspective. This is not a huge windfall, and get them focused on buying their first home. I also think it'll kind of bring into focus that concept from an early age. Maybe instead of going out and spending all that money on coffee or on dinners or going to the bars or whatever the case may be, maybe you do set aside an extra $100 or $200 in your early 20s towards that. And of course, it would give parents and grandparents that opportunity to save as well, allowing it to grow tax-free and of course be withdrawn tax-free as long as it's used for your first home purchase.
Yeah, well, 100 to $200 a month, that's my avocado toast money. So be careful
There you go.
what you're coming for here. How can we
You're our target market.
Yeah, exactly. How can we put this into practice a little bit? Because obviously there's a lot of good ideas out there, but making it a reality is obviously a large step. Have you put some thought into how to turn this into reality?
Yeah, we met with Sean Casten. He's a congressman, and his district is Western Springs, Hinsdale. That was I used to live in Western Springs until about 6 months ago when we moved to Chicago. We met with him as part of the Illinois Mortgage Bankers, and that was one of the ideas that we suggested to him. It was pretty well received, to be honest, but where it goes from there, I don't know. I think it's something that the MBA needs to get behind. The Community Home Lenders Association of America needs to get behind. Rob Chrisman needs to get behind it. Robbie Chrisman needs to get behind it. So I think it's number one, publicity, right? The more we talk about it, if people think it's a good idea, the better attention, it will receive, or the more attention. And obviously, if it gets the ear of a few congressmen, I mean, what politician does not want to be on the side of creating, affordable housing initiatives for people that would most benefit from this? And, like 529, let's be honest, that typically is going to favor your wealthy families, right? It's going to favor people that can actually put aside a bunch of money. This might help people that are, able to save 20 grand or 25 grand or 30 grand or 40 grand. So I look at it as a helping hand for people of even low to moderate income means, not just, serving the wealthy.
Yes, although I'll play a little devil's advocate here, and I'll say I went to the MBA advocacy conference in Washington, D.C. at the beginning of this year, and you go meet with representatives or senators or their aides, and you say, "Oh yeah, housing affordability. These are the bills we think would be good," and they're like, "Yes, of course, housing affordability," and then it gets nowhere some of the time. So things don't always work out in Washington, D.C. with the gridlock. I'm hopeful something like this could. I want to expand this conversation slightly, and I would say that you're focused on how can we help the average American family. Let's bring this in a little more to how we can win business in the industry. What are you focused on right now when it comes to winning business? What's playing well with borrowers out there? Pretty open-ended question. You could talk tech, you could talk relationships, you could talk products, whatever you like.
Sure. Yeah, obviously the 529 for housing idea is just sort of something that I've become passionate about over the last couple of months. That's not winning us any business at all. It's allowing us to talk a little bit about it, but it's more of just an idea for housing and hopefully something that can get some traction. As far as winning business with the tools that we have right now, I think in its simplest format, we as lenders need to create an enormous amount of value and be able to demonstrate that value to the consumer, to our referral partners, and through social media. I think we need to show home buyers, especially first-time buyers, a smarter way to buy a home. An example we have, and remind me to talk about our proprietary software that we've been designing over the last few years that is serving that goal, that initiative that I just talked about. But as an example, a very young first-time buyer, maybe 1 year out of college, is buying her first condo and using us as her lender. So she was referred from her dad, and he wanted to make sure she connected with somebody that she could trust, that was gonna walk her through a total housing budget, right? So we go through an entire total cost worksheet, which shows everything, your down payment, the lender cost, your title cost, your attorney's fees, of course, your prepaid interest, transfer tax, because she's buying in the city of Chicago, different down payment options that we showed, the seller tax credit that she's going to be getting. And again, we've designed this software that makes it easier to do that. And we'll talk about that more in a minute. And she felt very comfortable at the different price points. We educated her on, especially in the Chicago market and in many areas of the country, real estate taxes and homeowners association dues are as much of a driver on affordability as the price. You might find a condo that's 400 grand that is going to be more affordable on a monthly basis than one that's 300 or 325. I mean, the difference in HOA dues can go from 300 a month to 1200 a month. Obviously, you have totally different amenities and different sizes of buildings, but you really need to pay attention to that. So we walked her through that. We gave her a guaranteed pre-approval. And within the software, we've designed this ability for the borrower to self-serve her own pre-approval. So we put up guardrails, we put up max loan amount, max sales price, and allow certain fields to be editable where she can pull it from the portal and kind of like update it herself. We're still happy to do that, but every once in a while, it's easier for the buyer to be able to do that. She applied to the digital application. Of course, we did the pre-approval. And then we referred her actually two great real estate agents and a great insurance agent. So, fast forward 30 days from the start, she has very little anxiety from a financing perspective. She is totally confident from a budget perspective and from an approval perspective. She's working with a great agent. And let's be honest, there are some agents out there that do one or two transactions per year, and maybe they're a friend of your aunt or whatever, and you get connected with them and they don't 100% know what they're doing. Same holds true for loan officers, of course. So she gets referred to a great agent. They have a contract at a good price. They went through the first place, didn't get it. The agent actually said, you know what, let's back off. I don't like this price. I don't like the way they're negotiating. She gets a great deal out of it. She's incredibly well prepared. And I think that's in and of itself a case in point of what we as lenders need to do is to elevate our brand, have people understand the importance of getting their financing straight first. A competitor of ours uses the term financing first, and I think it's actually a great slogan. Get that together. We refer the real estate agent. We refer an attorney. We refer an insurance agent. It's extremely smooth, seamless transaction. And I would argue kind of better for the borrower that they got that financing out of the way early. So many of them still find a house, like the house, ready to make an offer and are in mad dash to get a pre-approval. And even if you might end up getting a worst rate or a lousy loan situation, but at the very least, you're going to cause yourself a lot of stress and a lot of anxiety doing it that way.
Yeah, and I do think that some of the public perception has shifted in the last couple of years from I should get a real estate agent first to I should get a pre-approval first, which is nice to see that shift a little bit. Let's talk about the 800-pound gorilla in the room here, and that's obviously tech and AI. What tech are modern borrowers demanding these days? That's kind of part A of the question, and part B is how does that interface with employees that work at a mortgage company?
Obviously, everyone needs a digital application, and you need a digital application that is intuitive, thorough, complete, accurate. I'm not sure if we're able to say who we use on this podcast, but I'll say it. We use Blend. We're very happy with them. I think they do a great job. I mean, they're asking the borrower for explanations on inquiries, late payments, linking all sorts of asset. We're getting, the holy grail of income rep and warrant relief, asset rep and warrant relief, and appraisal rep and warrant relief. I mean, you have a fantastic loan when you get those things, but the only way to do that is, of course, to link your assets. So if you're not doing that, you're obviously behind the times. We're doing it. We love that. But equally important, we ask our originators to do 3 to 4 Zoom calls per transaction with each and every client. The first one is upfront before they have a contract, going through total cost worksheets, creating creating their housing budget, issuing their pre-approval letter, getting all that buttoned up. The next one is a contract review, next steps, what needs to happen. That's obviously after they've found a property and have an accepted offer. The next Zoom after that is a closing disclosure, a final CD review, going through it top to bottom. If you did your job, they should totally understand it. It's basically a regurgitation of the loan estimate. And then the final one, a couple weeks post-closing, is a post-closing call. And that's where you talk about the power of prepaying, the compounding effect of taking 1/12 of your principal and interest, payment per month, adding that monthly and seeing an enormous amount of savings. So you have to use technology to make your job and the client's job easier. But you have to make sure you weave in the educational piece. And I just don't think clients are going to be, at least for a long time, really willing to take all of that from AI, to take all of that advice from AI, because people still learn better from people, and especially on a real estate transaction, which is still one of the more nerve-wracking things you do in your lifetime from a finance perspective. You want someone there that you can trust, and I just don't think they're going to be trusting of an AI agent compared to an actual person.
I agree. And I remember buying my first home thinking, I work in the industry and I still feel incredibly overwhelmed. I can only imagine what people that don't understand discount points or when to lock, all those sorts of things, it has to be overwhelming. So it does make the trusted advisor role that much more important in these modern times.
Oh yeah. I mean, we lived in a town for 25 years. We owned our home and an investment property right next to it, decided to sell both. And yeah, I own a mortgage company. I've been doing this for, I think 30 years at this point, 30 plus years, believe it or not. And I still had anxiety going through the entire process. Like, if you don't have somebody that you can talk to and talk you off the ledge, as opposed to, an AI agent, it doesn't work. You need that human connection.
Yeah, I saw a funny tweet a couple weeks ago that was like, the worst person in life right now is being told you're absolutely right by AI. So yes, always a healthy level of distrust for technology is good. Let me kind of close there. I want to ask you what your focus is on from an executive level perspective, because a couple years ago was, hey, how do we right size our company? Then a little more recently, it was, what tech should I be taking on, or what tech can I be getting rid of, or how do I properly implement tech? Where's the focus right now from an executive perspective of a mortgage company?
You mentioned tech. We're looking at both additional implementation of tech and reduction of different tech providers. So as I mentioned, we created our own proprietary software. Encompass does great things. Optimal Blue does great things. Our CRM does great things. But there's always these gaps in between where they're just not doing what a loan officer typically wants. So we took we spent a lot of time, money, other resources to create a software program that does all of the in-between steps. So creating advanced quotes that integrate with Lodestar, a fee provider, that integrates with OB, that integrates with all of the MIs to automatically pull up mortgage insurance quotes, and integrates with Encompass as well to pull in all that data. So it is becoming its own CRM. We've simplified what some of the big CRMs do and created that similar to a greatness tracker from the core. We call ours a success tracker, where you look at what you do on a weekly basis, where your wins are, your power moves, which are, lunches, coffees, dinners, face-to-face meetings, networking events, et cetera, to your touch points, calls, emails, messages, to your social media. And you have basically a scorecard in front of you. So that is a huge initiative of ours, but it's honestly, we're really building that technology around the processes that our loan officers already do and making them much better, much more efficient, and honestly, a lot more professional, both in the eyes of our loan officers, in the eyes of our realtors, and in the eyes of our clients. So that's been huge. And then just a back to basics, old school selling, a power hour or two every day of calling your pre-approvals, your buy-side agents, your sell-side agents, your closed clients, your financial advisors, your employers. I mean, talk is cheap. Everybody knows to do that, but you need leadership and your sales managers to get on board with that, to really embrace it. I mean, our operational workflow right now is extremely buttoned up. Slightly back to tech, we are working with an AI company trained that you can kind of ask them to do anything. So they're doing document indexing for us in Encompass. They're doing Patriot form executions. They're doing income calculations for us. So there's a lot of cool stuff that it's doing, and we're able to kind of do more volume with a thinner workforce. We're never looking to reduce headcount. We're just looking to be more efficient. So when that next boom comes, whether it be home sales or refis, we're going to be prepared, even if it doesn't mean adding a bunch, a bunch more bodies.
I really appreciate you making the time, man. It's super neat to hear your perspective. One thing I like about this podcast is I'm able to talk to a lot of different people in the industry, and I don't think I speak with enough executives just about kind of the decision making behind what's going on and what they're focused on. So I really appreciate you making the time. I wish you the best of luck on the 529 plan. Getting that out there. I think it's a great idea, and I'd love to have you back on sometime soon. So thank you.
Absolutely. Appreciate your time. Hello to your dad, and thanks again for having me.
This week's calendar contains no Treasury supply or Fed speakers ahead of the December 9th and 10th meeting. The November payrolls report has been pushed back from its regular first Friday of the month slot to December 16th, which leaves PMIs, ADP employment, challenger job cuts, and Michigan sentiment as the key releases this week. Some delayed releases for September are also on the calendar, including import prices, industrial production and capacity utilization, PCE, and durable goods orders. For mortgage-backed securities, the agencies will release prepayments after Thursday's close and into the evening. Today's calendar kicks off later this morning with final November S&P Global Manufacturing, PMI, and will be followed by the ISM equivalent. We begin the week with agency MBS prices roughly unchanged from Friday, the 2-year yielding 3.49 and the 10-year yielding 4.05 after closing last week at 4.02%, down 4 basis points over the course of last week. Let's wrap up with a joke and some housekeeping. There's only 1 month left in 2025, and I've never found out who let the dogs out, or where's the beef, or how to get to Sesame Street, why Dora doesn't use Google Maps, why eggs are packaged in a flimsy paper carton, but batteries are secured in plastic that's tough as nails, why women can't put on mascara with their mouth closed, why abbreviated is such a long word, why lemon juice is made with artificial flavor, yet dishwashing liquid is made with real lemons, why they sterilize the needle for lethal injections, and why do you have to put your 2 cents in, but it's only a penny for your thoughts? Where's that extra penny gonna go? Why did the alphabet song and Twinkle Twinkle Little Star have the same tune? Why did you just try to sing those previous 2 songs? And just what is Victoria's Secret? Thanks again to 2 Dots for sponsoring today's podcast. Their conventional screening agent replaces manual underwriting with a streamlined end-to-end process that reduces risk and fraud while securing safer borrowers, increasing profitable loan volume, and lowering underwriting overhead. Learn more at 2dots.net.